Hello everyone, this is group Let's Have a Break. And we have Chen Lianzhao, Feng Yi, Xie Jiamin, Yu Xuan, and Lin Jie in our team. Our topic is size effect and seasonality effect in China A-share market. We're trying to solve the problem whether the size and seasonality effect is significant in China A-share market. If so, we could construct our portfolio to hedge or to invest. Perhaps the most influential paper on overreaction hypotheses are those by DeBont and Thaler, who suggest contrarian strategies achieve abnormal returns due to the stock price overreaction to information. Their results were being debated. In the paper of Zero Win, he documents that only January is significant for losers outperforming winners when removing the size effect. And McKinley implies that majority of the profitability in contrarian strategies is attributable to common factors rather than to overreaction. In another paper, Chopra argues that overreaction effect is much stronger for smaller companies. Antonio documents that contrarian profits decline as one moves from small stocks to large stocks in Asian stock market. Abnormal profits of contrarian strategies are also documented in Chinese stock market. Kang finds statistically significant short-term contrarian profits of equal-size quantile portfolios. Zhang Bing indicates that for short-term data, January effect is insignificant. The research of Liao Jie indicates that month effects change depend on the development degree of Chinese stock market.
This is our dataset. We choose stocks from SCS 300 index to construct our dataset, and we use the previous 36 months cumulative excess return to rank all stocks of this index to construct our winners and losers portfolio, and then we calculate its excess return, the cumulative excess return, and then we use three models here. The first one is a dominant model, and D is a dominant instrument, 0 represents winners, and 1 is for losers. And RGMT is the cumulative excess return or excess return of stocks. And then we use a kappa model, it's also called risk model. And RAT is the difference of cumulative excess return or excess return between losers and winners. And then we use a cross-section regression, and we arrange the position of each stock of the portfolio to eliminate a side effect, and the CXSG is the tested period cumulative excess return. Especially, we take January as a special month, and analysis effect is also called the January effect.
My part is the data processing. Firstly, we use the data in the first time period, which is from 2014 to 2016, these 3 years, to do the comparison and ranking. After that, we use the data in the second time period, which is from 2017 to 2019, to do the regression and draw our conclusion. We choose the stocks in the universe of these 2 time periods and rank the return to choose the top 30 to be the winner group and the lowest 30 to be the loser group. We have 3 models. In the first and the second model, we introduce a dummy variable, and we choose 1 month treasury bill rate at the beginning of every month to be the RFT. We do these 2 regressions for different time months, and especially we focus on the January for each year. In the third model, we use the size at the beginning of the first time period to rank the 2 groups and divide each group into 5 small groups. We combine 2 corresponding small groups into a new group, which has 12 stocks in a group. And then we use the 5 new groups to do the same regression as in part 2. And we use the size at the beginning of the second time period to calculate the third model.
Table 1 examines the winner-loser effect in January in Chinese market. That is, losers have the tendency to outperform winners in the subsequent period. From the result, we can see that in 2017, losers outperform winners at the 95% significance level. Several reasons may be able to explain this phenomenon, such as size. Difference in risk between winners and losers may also be taken into account as well. Generally speaking, risk and profit are positively correlated, so we have to justify whether this difference is caused by risk. However, winner-loser effect in January doesn't exist in 2018 and 2019. This may be due to the short time of our data selection. Because the development time of Chinese market is relatively short, there are fewer stocks with trading data in a longer time range. It may also be due to that the winner-loser effect in January is related to January effect, but the January effect in Chinese market is not obvious. One of the explanations is the tax loss hypothesis. According to the US tax law, the losses of selling stocks are tax deductible and is not calculated on the books, but on the basis of actual trading. In order to reduce the taxes they have to pay, many investors will sell loss-making stocks before December, resulting in a weak market situation in December. But in January of the following year, investors will reinvest in the market and then drive the stock market up. However, there is no tax reduction policy when stocks lose money in the Chinese market. This part is about whether the differences in risk can explain the discrepancy between winners and losers. We use this formula to get table 2. RAT, alpha, and beta are the difference between losers and winners. Part of the difference in returns is caused by risk, and the other part is caused by non-risk alpha. According to the regression of the Chinese market, at the 95% significance level, it can be considered that beta is positive, which means that loser is riskier than winner. But at the same time, alpha is also positive significantly for all months, indicating that risk cannot fully explain the greater performance of losers. In other words, even controlling for risk, losers still have superior performance.
Since my team member mentioned just now, it is well known that smaller firms outperform larger firms. In this part, we began to explore whether differential size is responsible for the tendency for prior period losers to outperform prior period winners in the subsequent period. We used the Johnson performance test model and methods mentioned before to explore it, and this is our result. From the result, we can see that after controlling for the size variable, losers outperform better than winners only from February to December. In January, only the second smallest size group shows a superior performance of losers over winners at a significant level of 95%. There is no exhibition of the winner-loser effect in January in other 4 groups. In groups that have significant results for all months, the smallest firms tend to have the most significant positive alpha. To go further, we straightforwardly test the relationship between size and subsequent return by the following regression model, and this is our result. From the result, we can see that only from February to December in 2019, the size is considered to have a negative impact on stock returns at the 95% significance level. That is, small companies have higher returns. Because the data in January are not significant, we cannot figure out that size in January has an impact on stock returns. In conclusion, this paper tries to explore whether small companies have stronger loser-winner effect in January in Chinese markets. But based on our exploration, we found that, firstly, loser-winner effect in January is not obvious. Secondly, the loser-winner effect cannot be fully explained by risk. Thirdly, in the Chinese market, smaller companies do not have a stronger loser-winner effect in January, and the size fact does not affect the existence of this effect. These papers still have some shortcomings. For example, the data selection interval is short, which makes the conclusion not robust enough and only reflects the state of Chinese market in the past 3 years. With the development of Chinese stock market, we hope to select more available data to explore in the future. That's all. Thank you for listening.